We got inflation data this morning. CPI data came in, headline and core, and I wanted to talk about what the inflation numbers mean going forward with the economy, the Federal Reserve lowering or raising potentially interest rates, the new administration with some of their policies and what that could mean for the debt markets and what that might mean for the Federal Reserve with their current policy. Now, many of you have been following me on my TLT stock trade. TLT, of course, is the bond ETF. I have a long-term position I started putting on very early in this year, a little bit in 2023 because I felt like the market was about at its bottom for TLT stock. In the meantime, TLT stock had shot up to about 100 and has fallen right back down. I've gotten some emails asking, am I buying more? Let me break down what happened with the CPI data this morning, what this could mean for the Federal Reserve, how the economy is doing, which would also affect the Federal Reserve, and an incoming administration. There's a lot of new information. Let's jump in and I'll break down TLT stock. For those of you who've been following me for some time, I have a TLT trade stock on that TLT stock trade that I put on earlier this year. Unfortunately, right around June, July, August, some personal things kicked in, and for content creation, which I don't make a fortune off this, I felt like this needed to kind of step back. I took a couple months off to finish up some of those projects that were just nagging and nagging and nagging. I should be back 100% January 1st, but over the course of the next 6 weeks going into December, I hope to put out about 2 to 3 videos per week, and I should be pretty consistent with that because a lot of the projects I've had are done. So that's where I've been. Here we're looking at, let's jump in, core annual CPI data, and as you can see, this is the change annually. We've had a little bit of a jump higher. Now, most of the jump or increase in the core rate for this month, for the year over year, is coming from housing. This is a big concern. And if you saw anything after Tuesday, Wednesday, starting Wednesday, the mortgage market rates shot higher because of concerns with the incoming administration. Now, to start off with the tariffs. First, I don't think he's just going to sit there, show up day one and say, F it, and just put tariffs across the board. But then again, you never know. What I believe is if we do see tariffs of any kind, that it will be a gradual process. He's going to complain as much as he can and try and get a great deal. We had tariffs previously. They were inflationary. I will show you the charts on that. They acted as a tax, and CNBC kind of did a report. That tax acted as the biggest tax on Americans, tax increase on Americans in decades. So it is kind of a big deal. But again, I don't think he's just going to walk in day one and just sign a piece of paper and that's it. These particular tariffs are looking like they would raise costs by about $4,000 per person here in the United States. So if you're at a median income, that's about 10% of your income. Now, tariffs themselves, presidents don't do this. The reason why we haven't done this since the Smoot-Hawley Act in the 1930s, they are so terrible for the economy. While I can see that an incoming administration would want to bring jobs back into the United States of America, I really caution that. We're at 4.1% unemployment rate. How many more jobs can we possibly need inside the United States? Keep in mind, China, they make our underwear. Who's sitting around saying, God, if only I could start making underwear again here in the United States? But we'll see. There's a lot of concerns. The economy itself, back in 2018-19, prior to 20, of course, started to kind of rebound somewhat. The stock market moved back up above its pre-tariff levels. So it'll be interesting to see how this plays out moving forward. Here is headline versus core. The green here is the headline number, and as you can see, it's starting to move a little bit higher. Now, my analysis always starts with what's going on with the consumer. Government expenditures tend to be very flatline. You need an act of Congress in order to really shift expenditures much higher. And if you look at the U.S. government expenditures, they're continually increasing higher and higher and higher every year. That's a pretty steady as you go number. The consumer is the one where you'll see changes, shifts based on the economy itself. Now, our economy right now is quite strong. We are seeing increases in incomes, which are translating into increases in expenditures. Those are translating to increases in inflation. Again, it goes back to housing. If you look at the big chunk of what we're looking here, these big spikes, that was housing. So to see the mortgage rate spike back up, they're very concerned, the mortgage markets are very concerned that some of the inflationary possibilities in the future are going to play in. Here is a chart that I look at frequently. This is personal expenditures versus CPI data, the core number. And in this particular chart, what you're looking at is personal expenditures are starting to trickle back upwards. That's the blue line there. And the core rate is the green there. You can see the correlation. Obviously, it's not a one-for-one correlation, but they typically trend together. This is why I continue to look at personal incomes, personal expenditures, and then the effects thereof. What happens is, as we get more and more people on the payrolls, incomes increase overall in the United States. You'll get people who get raises, you'll get people who get hired. That combination drives personal incomes. The year-over-year change, which you're looking at here in these charts, drives expenditures. Expenditures drive inflationary pressures. Housing is a big concern, and that has more to do with limited supply and a lot of demand. But with the mortgage rate moving higher, that demand will be kind of narrowed out a little bit. Here's a look at, this is the U.S. 10-year Treasury. It's over a couple days here, but you can see first, all the way over on the left-hand side, you can see the Trump trade. When Trump was declared winner on Wednesday morning, the U.S. 10-year Treasury yield shot higher. Again, a lot of his policies are inflationary, first and foremost. In March, I believe it is, his tax cuts to corporations are just going to roll over. Now, why is that inflationary? Real simple. He gave tax cuts to corporations, which means the government is taking in less revenue. That less revenue means more debt for the government. And as the Treasury has to offer more debt, they have to lower price in order to entice buyers. So the excess deficit will be inflationary. In that regard, the bond market played that out. Today, the chart all the way on the right, you saw initially that the inflationary data was taken well, but then the bond yield kind of bounced right back upward. Now this is, I want to say it's about 1 o'clock in the afternoon in New York, so it's 3 more hours left in New York. Chicago, where bonds are traded, it's about the same. We'll see where it plays out by the end of today, but in general, and let me move, here's a bigger look at the U.S. 10-year Treasury. For me, the U.S. 10-year Treasury is sort of the barometer. You look at the 10 because it's a good halfway point between, say, the 30 mortgage rate or the short-term or 2-year. So, and there is a 2-10 spread. I will get into that in the next video. We don't need to look at it right now. As you can see, the long-term trend, we're heading back upward. And I don't think we're going to see huge spikes in inflation to the point where the Federal Reserve has to start raising interest rates. But I also don't see there being a big reason for the Federal Reserve to shift back to an accommodative stance. They may be where they need to be simply because the economy right now is still very strong, and if we see inflationary numbers continue to move higher like they just did with the core rate at 3.3%, the Federal Reserve may not have any reason to really lower rates. This is something I talked about previously in videos, that I felt the Federal Reserve would lower interest rates at a begrudgingly slow pace. I didn't anticipate these new sort of outlier events with the potential of tariffs showing up being something that would really kind of compel the Federal Reserve to do one thing or another. This is new information. So we'll see how this plays out. Again, I don't think he's going to show up and just blanket sign a document and all of a sudden Americans are just taxed in a whole new way. I think this will be progressive, and I think the economy is going to be able to push forward. This will keep inflationary prices somewhat elevated, but it's really a lot more having to do with housing. All right, TLT stock fell again. It had fallen hard all through the night on Tuesday night into Wednesday morning. You can see that there. Started to rebound back to where it was, but then fell again this morning. Here's a bigger look at the overall picture. TLT stock, of course, is the inverse to the Treasury yields. Now, I always show the 10, but TLT stock trades off the 20 and the 30. But it's not a one-for-one relationship. This is so important to understand. What are you willing to pay for a certain percentage of yield? At any given time, that may change from day to day. And this is one of the reasons why TLT stock has kind of eased off. But I don't think we'll continue much lower. Here's the reason why. If the stock market starts to tumble a little bit, if the Trump trade plays out, what'll happen is the stock players will get out of their stock positions and start buying into interest rates, because at that point this is a guaranteed, say, 4.5% interest rate yield. And that may not be around for very long. We may see TLT stock moving to 92.5, back up to 95, then sort of mellowing out at that point, waiting for more data points to come in to drive interest rates one way or another. We need to see what's going to play out with tariffs. We already know what's going to play out with the tax for corporations. March comes around, he's just going to sign it. Why wouldn't he? Given that, for TLT stock, I still feel like we're pretty close to the bottom of the trade. I'm not adding more. As far as TLT stock goes, I have a pretty decent sized position. I don't see TLT stock moving too much lower over a long period of time. In the meantime, you get dividends, which are yields coming through, and that's fine. I'm playing other things. I'm playing a lot of crypto. Ethereum, Sol. I don't really play Bitcoin too much, but from time to time it gets my attention. Here is CPI inflation data, and I'm pointing here with the big blue arrow. That's Trump's tariffs, his initial tariffs. So inflation had been drifting slightly lower, and these numbers are, I could probably zoom in there. There was inflation because of this. This shifted. Now keep in mind, this wasn't exactly a big tariff across the board. It cost Americans about $500 a year. Not huge, but still inflationary. Now what happened immediately thereafter was, of course, COVID, and inflation fell off the roof, or fell off the roof. What we're looking at now, what we don't know is, what if COVID wouldn't have shown up? Could this period of time, price pressures moved higher? Possibly. but we don't really know. And Trump rolled back his tariffs, declared victory, and all was well. But there could have been more price pressures. Keep in mind, however, right now, his proposals are far bigger than what he did before. An order of magnitude by, just one order of magnitude in expenditures, maybe a little less, but that'll give you an idea the potential tax on Americans going forward. That would be inflationary. In the meantime, we're not seeing those price pressures now, but we are seeing housing trickling back upward. Fortunately or unfortunately, mortgage rates are moving back upward as well, and because of that, that could sort of pump the brakes on housing inflation itself. So going forward, I'm not adding anything new with my TLT stock. I think that's position sound. I'll sit on it. I'm earning some interest, but a lot of my activity right now is in my crypto trades. But I am probably going to be starting to shift things back and look at some opportunities like XRT, the ETF. That is an ETF on retail stocks. If we see tariffs across the board, I'll be shorting that all day long. In the meantime, if you're looking for content where I'll break down the economy and a specific stock sector and how the economy affects these sectors, make sure to hit that like and follow button. We'll see you in the next video. Also, I have my Substack newsletter, link down below. We'll see you in the next video.